invited Paul Ho, Senior Director of Asia Equities team, and Choo Chian, Director of Macro Strategy and Multi-Asset team, to share with us their views and insights on the overall macroeconomic outlook. At the same time, we hope you gain valuable insights into the markets as well. So let's quickly get started. Here's the agenda for today as well. So for a start, we will look at, I'll just do a brief introduction in terms of the UOB Asset Management, who we are and what we are doing as well, for those who are still probably a little bit, who do not know us that much as well. Then I'll actually introduce Chen to come in. He will actually do go a deep dive into some of the key global market trends as well. Following that, Paul will actually go through a deep analysis of the China and the Asian markets, and we'll round off with a quick Q&A as well. So before we start, let's probably go through some of the housekeeping as well. So the chat box is available. If you have any connectivity issues, please raise it up to our Zoom host as well. Anytime during the session itself, click onto the Q&A icon to ask any questions throughout the session. And also you can click onto the like button to upvote the questions that are being raised in the Q&A section. Scan the QR codes at the end to access the feedback form or any of the links that we have put up. At the same time, please note that this is actually a public webinar, so you'll actually be recorded as well. So who exactly is actually UOB Asset Management? So UOB Asset Management, UOB AM in short, is actually a leading Asia-based asset manager with headquarters in Singapore, and is a wholly owned subsidiary of UOB Group. We have grown extensively across Asia with presence in 9 markets, namely Malaysia, Brunei, Japan, Taiwan, Thailand, Indonesia, Vietnam, and a joint venture with Ping An as well in China. We currently have about more than 36 billion in assets under management as of August 2022, servicing a wide range of clients, including government organizations, pension funds, corporates, as well as retail investors as well. We have an experienced team of more than 90 investment professionals who conduct rigorous fundamental research with a proven investment framework to provide our clients with innovative investment solutions. Next. As a company itself, we are also committed to investing excellence. Our main vision is to be a trusted asset manager in Asia, leading in innovation and sustainability as well. To achieve this, we rely on 4 key pillars, namely, being at the forefront of digital enhancement. Second, focusing on sustainable investment, investing for both profit and purpose as well. Third, keeping customers at the center by providing top-of-the-class investment solutions and performance. And finally, to embrace our Asian heritage and regional expertise as well. Next. So a little bit more into UOB AM itself is that we are also we are actually part of one of the regional asset management firms in Singapore to join the PRI. So PRI actually stands for the United Nations Principles for Responsible Investment signatory. So as one of the UN PRI signatory, UOB AM is required to fulfill key obligations as well, namely incorporate ESG issues into the investment analysis and decision-making processes, be active owners and incorporate ESG consideration into its ownership policies, promote acceptance and implementation of the principles within the investment industry as well. So a little look into what we have been doing over the last 30 over years as well is that we have won numerous awards, almost close to 300 investment awards since our inception in 1986. This is really a testament to our strong investment management capabilities that you investors can take comfort in. We are also very strong in the sustainability space as well and won numerous awards as seen in the bottom table as well. Next, so a little bit introduction into today's speakers. So we have Paul today. So Paul is actually our Senior Director for the Asian Equities team. He has over 27 years of investment experience and manages a number of Asian funds at UOB AM. Together with him, we have Choo Chian. So Choo Chian is actually the Director of the Macro Strategy and Multi-Asset team as well. So he's responsible for managing several global and Asian multi-asset portfolios as well. So without further ado, let's probably invite Chen to kick off the session for today. Chen, please.
Thanks, Roger. Good morning, everyone. Happy New Year to all. Certainly last year has been a challenging year for everyone, but I think this year is probably going to be somewhat different. Just to share, I think the title for the presentation today would be More Clarity and Opportunities in 2023. Okay, first, let me start off with the macro investment outlook before we go a little bit more into the opportunities that we see. First of all, I think last year has been a tricky year. I mean, while we do know that growth slowdown was to be expected, but I think it was exacerbated also by the Russia-Ukraine war, causing pretty much inflation to spiral beyond what central bankers were thinking. Policy tightening was stronger, faster than what people were thinking. And as a result, risky assets certainly took a hit. And alongside that, I think the only two asset classes that would produce positive returns was pretty much just commodities and cash. So I think this year, going from here, I think the key questions that people are grappling with would be whether the global growth slowdown would worsen, whether inflation would improve sufficiently to what central bankers are thinking, and whether how central banks would react to different combinations of macro trends. On the growth slowdown, for now, we foresee that the deceleration is still more muted versus past hard landings. For now, our forward-looking macro view is not that negative. Significant unemployment is unlikely. Having said that, we don't necessarily exclude a hard landing further out as well. As for the second question on inflation, I think we are fairly confident that we have seen the peak of inflation late last year. Going forward from here, I think we do foresee two of the three categories of inflation coming down, primarily core goods and as well as the rent shelter inflation component. Further out, I think there is actually less clarity on the last category, which would be wage growth, the services ex shelter components. In any case, our base case would be that inflation would come down to around 3% by the end of the year. Central banks would near the end of their rate hiking cycle, and that we do not expect a classic recession, and that there may be a rebound later this year. At this juncture, we are overweight fixed income. We have turned neutral on equities and also neutral on the rest of the commodities and alternatives, and underweight cash. Okay, going into the inflation and growth outlook for 23, again, this will be the key drivers for the year again, although there's likely going to be some macro disparity across the regions and countries. But first off, I think in a hard landing scenario, equity returns would certainly be negative from here. But if it was indeed a peak inflation, equity returns actually tend to be positive following thereafter. So I think the question now is whether do we see a hard landing like what we saw in the late 70s and 80s, or would there be more like a soft landing? For now, I think the consensus still thinks that the consensus is actually a little bit more pessimistic. We are a little bit more optimistic in achieving a soft landing. Earnings growth is still positive this year and next. I think it remains to be at risk should hard landing materialize at some point eventually, if so. Yeah. And as for inflation, whether it would moderate sufficiently in 23 and whether would it be enough, I think the question is now for central banks, whether do they need to tighten further to bring about demand destruction. For now, it does seem that the labor market seems to be still fairly tight. The jobs to workers gap still remains fairly wide. Unemployment rate still remains fairly low in the developed markets, US and Europe, with fairly little signs of easing wage pressures at this time. Hence, therefore, central banks will still have to keep at it to cause some demand destruction, jobs openings to fall before they can declare a victory on inflation. Okay, I think different combinations of macro trends could result from what is going to happen from growth and inflation. Starting off from the upper left quadrant, a soft landing coupled with declining inflation, we would term that as Goldilocks scenario, which is pretty good for risky assets. So that is a so-called non-eventful, so to speak. However, if we move towards to the right side, where there is a soft landing with persistent inflation, that would be the overheated quadrant. In this case, we could see a plateau in the central bank's policy rate. Potentially, that could be a rate hike or rate hikes towards the end of the year. We don't exclude that. So that would be a overheated scenario. Moving further south to the lower quadrants, if there was a hard landing coupled with declining inflation, that would be so-called a classic recession. And in fact, I would argue that this is pretty much the consensus is what they're thinking about, in the sense that I think we do, at least the market sees policy rates easing by the second half of this year. We think a little bit differently, but I would say that this is what people generally think would happen. So basically, things would worsen, and therefore the Fed will cut rates. So that's a classic recession. Finally, we also have the hard landing coupled with persistent inflation pressures, and that would be the stagflation scenario, which is certainly that would be the bugbear. This was actually what we saw in the late 70s and as well as the early 80s. This would certainly be the worst outcome to have. But for now, I don't think this is the central. This would be still a tail risk scenario at this time. So for now, market consensus is expecting the bottom half of a so-called hard landing. About 70% of economists are expecting that. We think a little bit differently. We're still expecting a soft landing in the near term. Okay, and why do these different combinations or quadrants matter? Simply because different asset classes would do well in each of these different quadrants. So, for example, last year we saw that we were clearly in the lower left quadrant of the stagflation. That would be the cash where commodities and cash outperformed. Commodities was up about, say, 10 to 20%, followed by cash, probably around 5% or so, whereas equities was down 20, 30%, fixed income was down 10% plus. So I think clearly that was where we were. In fact, I would say that was the fear of the stagflation, the peak stagflation fear that we saw that caused a so-called a correction, sharp correction in risky assets. Pretty much there was you can term it as a two-prong recession. First would be the PE multiple contraction with the Fed pivot following the end of 21. 21, yeah. And then after that, there was the fear of the earnings recession. But I have to say that didn't really come to pass. That still people are still expecting positive earnings growth this year and next. So we have to see whether that is necessarily, that will still hold. But I think the key question would be whether this year would be a repeat of last year, or would things turn out to be somewhat more optimistic and more sanguine than what people are thinking. So, okay, so let me share a little bit more in terms of the growth outlook for 23. So I think for the US, certainly the US Fed remains determined to cool the overheated economy. And I think the question is whether they will end up in a still and stalled state, or would it actually pick up momentum as the quarters go by? So I think that's the first question that people are wondering. For now, I think we remain optimistic at this juncture. And as for Europe, I think it's fairly clear that there is a recession. The only reprieve I think we see that the recession is likely to be more shallow than what people are expecting. And in particular, we do observe that the gasoline gas prices have actually came down quite a bit. There was also a warmer than expected winter that is easing some of these pressures. So in short, I think Europe may not be, the growth slowdown may not be as bad as what people feared. Coming across back to Asia, certainly we see China reopening, causing optimism across the Asian markets. Yeah, so I think that's part of that. But I think it still remains to be seen whether necessarily investors would hold how they think and perceive of Asia growth engines, and as well as the PE multiples they will accord them with going from here. I think that is still some question there. Finally, to take note within Asia, in fact, I would say that a subset, ASEAN markets have did pretty well last year. Simply because I think most of them were actually fairly insulated from some of the inflation shock. In fact, I would say that macro-wise, some of them would actually benefit from some of the terms of trade improvement caused by the high energy oil prices. Going from here, I think it remains less clear as to whether they will necessarily benefit going forward from the peak inflation narrative. So moving on a little bit to how we think about things. In-house, we have actually developed forward-looking growth signals for the major economies of the world. Here, the blue bar represents the strength of the economy for the US, while the orange bar represents the strength of the China economy. So we can see that I think the US still is likely to hold up in the near term, still not showing very little signs of deceleration. If it decelerates as what we saw in 2020, the COVID, you will see the blue bar shrinking further smaller. But for now, I think it is still fairly healthy. So that's for the US. And for China, we do know that it's been that's vacillating a little bit between expansion versus recession. But I think there seems to be fair odds that I think we will be moving back towards a recovery from here. So in short, I think we don't see marked deceleration in the US economy. So therefore, I think we have conviction that it's still a soft landing in the near term. Okay, so as I shared, whereas we think of what we think would be a soft landing as our central scenario, most forecasters and economists think otherwise. In fact, they expect a recession this year, with easily over 70% of them thinking that there'll be 50% and above probability of recession this year. So you can see that the green dots are each of the sell-side economists. You can see that pretty much all of them are on the right side of the chart, whereby many of them think that a recession would come about later this year. Having said that, I would still note that there still remains a fairly notable minority, about say 30 to 40%, that think otherwise, that in fact a soft landing could be achievable. But this shows you where the market is now overall, where the economists are. And in aggregate, you can see that we can observe the first line for global. We see a subpar growth this year, 23 below 3%. And in particular, this will be dragged down by the US, just registering slight positive returns, 0.4, 0.5 thereabouts. Eurozone will certainly be negative, minus, but I think this could be less bad as what people feared. Whereas in Asia, I think the growth rates are actually healthier, closer to 5% or so this year. And having said that, we do take note that there could still be hard landing risks in this environment, simply because the Fed funds rate remains fairly so-called high, and also that the inflation also stay high above 4%. Just as backdrop, the core PCE and as well as the core inflation, which is what Fed tracks, currently right now is at about 4.7 to 6%. Over the end of the year, I think we are expecting close to around 3%, slightly higher or so. That should be sufficient for the Fed to pause. Thereafter, after reaching say about 5.25, 5 to 5.25 or so. So I think in this sense, I think we would be able to avert a hard landing. But having said that, if inflation does indeed stay above 4%, with the Fed funds rate staying high, then certainly the odds of a hard landing certainly can't be ruled out. Yeah, so that's so in short, right now I think we would still be in the so-called overly hawkish camp, but in time to come, I think we think it will likely lean towards soft landing, but we're cognizant that it could still result in hard landing should inflation stay higher, stay stickier than what central banks are thinking, policymakers are thinking. Okay, and as for the inflation outlook, I'll cover this in the next couple of slides. We can see that things have been easing, primarily from core goods and as well as the rent shelter inflation. But again, if it doesn't fall back to below around 3%, the US Fed could be forced to remain in inflation fighting mode thereafter still. So just to show a couple of charts on how the inflation is improving, you can see that the left chart shows you the core PCE goods, how it's been coming down in the last couple of months. And you can see that this is coincident with what the global supply chain pressures are suggesting. They are easing and likely to ease further from here. Yeah, the team has done extensive work, so I think we are fairly confident that this will continue to stay down. The other category that is important would be the rent shelter inflation, also known as the owner's equivalent rents in the US and UK. This is actually fairly unique to these markets, but I think with the with the peak in home prices and as well as asking rents of new leases, we do expect this component to start coming down the first quarter of this year. So it will become clearer that the inflation is the downward trend in inflation is coming through in two of the three big categories. But having said that, I think for core services, I think this part could likely remain tricky, simply because that you see the right chart shows you that the total labor demand or jobs continues to exceed the labor force. So therefore, even as the Fed seeks to engineer a soft landing, uncertainty still remains as to whether the labor force participation rate would normalize higher. So early on, I think there was all this generous fiscal packages, be that people thought that were keeping people at home. But still, I think it still remains, the participation rate still remains depressed. And I think the question still remains as to whether the great so-called resignation, whether there could be more enduring than what people were thinking. In short, the mindset change, triggers, and even the modes of working, whether that would persist from here. And finally, moving on to interest rate implications for this year. Certainly last year has been a fairly stark move. You can see that, it has been very sharp versus the last couple of cycles, in the 2000s and thereafter. Typically the rise has been actually fairly mild and spread out, but the last year has been fairly sharp and quick. So this is, while it seems to be fairly, kind of a shock to what the 2 decades, what people were thinking, but I think this is actually not very surprising if you actually use back the Taylor rule, which is what the Fed is looking at. So this certainly would be closer to what a hard landing would have seen. But even in a hard landing, typically the rise in interest rates is closer to about 10 percentage points. So we are maybe about halfway there, thereabouts. So this gives you perspective to what the experience has been. Going forward, I think market participants are thinking that rates would peak. In fact, they will fall by the middle of this year. I think we think a little bit differently. We remain a little bit more. We think that the Fed will still hold on to their guns thereafter to see whether inflation trends necessarily turn out the way that they are thinking. So in short, we don't necessarily buy the idea of a Fed pivot. And then finally, for the Bank of Japan, which is pretty much the last central bank to change their stance, they lifted the cap on JGBs to 50 basis points from 25 basis points at the end of last year. Fixed income markets continue to price in further yield curve adjustments or a lifting of yield target. So essentially, I think all the central banks are moving towards a more hawkish stance from here. Okay, so if I just quickly move to the conclusion now, right now we are overweight the fixed income markets. We think that the upside-downside risk still favors fixed income at this time. We have turned neutral on equities and as well as most of the other asset classes, and we are underweight cash. Okay, I think that's pretty much all I have for you at this time. Let me turn over the time to my colleague Paul, who will walk you through the Asia markets. Thank you.
Okay, thanks very much, Chien, and good morning to everyone. So today I'm going to share a bit more, from the perspective of an equities manager. So as a background, I've been investing in the equities market for the last 27 years. So maybe that's made me a bit more pessimistic than Chien. So I'm going to share with you some of my own views, which again might be a bit darker than what you've just heard. But just bear in mind, I think the situation or the environment right now is not very clear. I think there's a lot of debate on what's going to happen. As Chien also rightly pointed out, we have taken a pretty contrarian view to the market. But I think as equity investors, we should take into account also the view that the markets might just be a bit more rocky going forward. But before that, let me just take a kind of a humorous look at what happened in the 2022, right? Now imagine yourself going back to this time last year, and you're trying to make a prediction on what's going to happen in the 2022, and assume that you were such a good forecaster, and you knew that there was going to be an energy crisis in 2022, and you place your bet in the oil. And guess what? By the end of the year, you actually didn't really make much money, right? The oil was only up 2%. And let's assume again, you knew that there was going to be a war. You're prescient. You knew that Russia was going to invade Ukraine, and you think, oh no. Coupled with this energy crisis, Europe is going to be suffering. Therefore, European equity is going to be a bad idea. And I think you better, put some of your money in the US. Where growth is still strong, and you want to invest in gold as a hedge. Well, as it turns out, last year European equities outperformed the equities outperformed the US. Gold was actually down 0.6%. So you're thinking, of course, at that time, by then you would have a very negative view of the market, right? You think, oh, markets are definitely going to be risk off this year. Well, you put your money in the bonds traditionally where you are high. Sorry, bonds were down 30%. And then this last one is my favorite, right? You invest in the emerging markets, and you said, well, Turkey. You look at Turkey and say, it's a basket case. It's hyperinflation. So just to give you an idea what hyperinflation is, in December, I just saw the data just now. December last year, inflation rate hit a 9-month low of 64%. Right, it's down from November, 84%. So that's what hyperinflation looks like. The economy is collapsing, and the Turkish lira, well, it dropped 78% in 2021. Another 40% from there in 2022. That's not to mention that you already dropped 25% in 2020, right, 2 years ago. So, hey, well, guess what? It was the best performing stock market in the world last year, up 102% in USD terms. So what can I say? Investing is easy, right? Now sorry, there was somebody, my colleague sent me another very interesting chart, which I shall not show. Basically, one of the largest, somebody kept track of the predictions, top 10 predictions made by one of the largest securities houses in China. With all their resources and all their analysts, they made 10 predictions for 2022. Turns out 9 of them were wrong. Right, so with that in mind, we're going to go boldly forward and present, what you think was going to happen in 2023. Now, I think there are many things that are not very clear in the market right now. And to be honest, I think, I've looked at the markets for more than 2 decades, and this last year and this year definitely is one of the highest, kind of uncertainty that I've encountered so far, right? So I think Chian mentioned just now, yes, I think the majority of the market is still expecting a recession, and how likely is this? So this is not done by us, it's done by organization called the US Conference Board, right? And they forecasted that right now, based on the US recession probability model, there's 96% probability of recession. If you look at their track record, right, from 1976 until now, I mean, they when the probability model is this high, very often you do get a real recession. And if you look at the markets, I mean, I'm a markets person. If you look at what the markets are telling you, in fact, the markets seem to be confirming this recessionary signal, confirmed by this U curve inversion. So this is one of the things that people look at. How many percent of the US U curve is actually inverted? And currently, right now, is close to 91%. And again, you look at the history of this. It goes back to 1970s again. And every time, first of all, if it crosses a threshold of 70%, something serious is going to happen, right? I mean, you look at the history. I think this chart is self-explanatory. At 91%, I think very bad things happened in the past. So we're not sure whether it's going to happen. It hasn't happened yet. But we all bet on probability. So I think, highly likely something will turn up, but we don't know what it is yet. And then this is very interesting. So a lot of discussion on how severe this, well, if we assume that there's going to be a recession, again, it's not a done deal. How severe would it be? So this study was done by the Federal Reserve Bank of St. Louis. So the St. Louis Fed, right? It's done by one of the Fed banks, not by us. And they found a very interesting correlation, right? They said that actually this U curve inversion is a very significant event for markets, and it's a very good predictor of what's going to happen in the future. And they found this, and they said, at the time when the U curve inverted, what was the real interest rate? And that will give you a very good clue what will happen in this recession. Is it going to be serious? Is it going to be not so serious? So the answer is that higher the real interest rate at the time of the U curve inversion, the less severe the recession. You can see from this chart, right? So and less severe in 2 ways. One, in terms of the length, you see here. So basically the lower the rate when it was inverted, the longer the recession. And guess what? I mean, what happened when the yield curve inverted this time around? So the yield curve inverted, I think, was sometime in July 2021, the first time that it actually inverted. But fair to say, even if you took the subsequent times that it was inverted, I think we are literally off the charts, right? The real interest rate at the time was actually negative. So as you can see, it's never happened before. So you can extrapolate, you know, you know, how long this coming recession, if it happens, is going to be. Same thing from the same study. The Fed themselves are saying, look, in terms of maximum unemployment rate, how severe would this be? I mean, so again, if you had, I think they had to extend the x-axis, right, to negative. So negative rates, what would the unemployment look like? So I leave that to your own extrapolation, right, from the study that's been done by the Fed, one of the federal banks itself. Now, and this is an interesting chart, right? So you know that money supply is the lifeblood for equity markets. And what you just seen, we've seen the sharpest decline in the money supply ever, right? You look at this chart, and it goes back to 1960. Surely this is not an insignificant event, right? And what does this actually mean for markets, right? So you can see, like I just mentioned, that the money supply is a lifeblood of equities, because it drives equity. So the more money you print, the more of it goes back into the markets, pushing the share prices up, right? So you see there's a very tight correlation between the liquidity in the markets and the eventual performance of the equity markets in general. So, but with a lag. So we have a sharp decline in global liquidity. Eventually, this should catch up. I mean, the equity markets should, I would say, catch up, should catch down in this case. So I think, again, I leave you to draw the conclusions from this chart. What's going to happen, or what is the most likely thing that will happen, if a recession does develop. So now the other thing is, people are wondering, so if the majority of the market is correct, and recession develops and the market goes into decline, the question is then when does the market bottom? I mean, how do we know when we should start buying more equities? I think this will provide quite a good guide. I think at the very least, one of the first conditions that has to be met before the market has bottomed is that normally, again, according to history, right, not according to me, but Fed has to cut rate first, right? One of the first things that has to happen is that the economy has to be so bad that the Fed has to cut rate. And if you can see from the chart, the Fed has to cut a couple of times before the market actually bottoms. So again, if you are thinking, or if recession does develop and if the market goes down, equity markets goes down from here, then when the Fed first cut, remember, don't get too excited yet, because from history, normally it takes a few of those cuts before the market kind of bottoms. So anyway, this is for your guide. But as of now, no signs of Fed cutting, as my colleague Chen has pointed out. Well, to me, I think probably unlikely that we've seen the worst yet. And the other thing I want to highlight is the equity markets in the US. Now, so we realized that actually there is probably a lot of room to fall. I mean, given what the market has done, given the valuations. Again, this market, I said, is crazy expensive versus the rest of the world, right? You look at the relative. Its own relative history. You see the internet, that's the internet bubble. And then for those who are old enough, 1960s, the Nifty 50 bubble. And then there you have it, where we are right now. So again, I leave it to your imagination that how much more that it has to revert. And these things, I think most likely would revert. So the rest of the world, meaning I think mainly emerging markets, which is what we look at, And specifically, what does this mean for Asia, right? So if you're going to hide in Asia, and it seems like in general, emerging markets looks like a better place to be, a cheaper place to be, possibly safer in that sense, and hence most likely to outperform. But if you look within that, Asia itself is also very attractive at this point in time. So we see that China, Korea, Taiwan is cheap, right, relative to the rest of the emerging markets. But special mention to India, right? Because India is very, I would say the valuations stand out, right? In a bad sense. It's first, it's the most expensive, emerging market, and second of all, it's so expensive that it's more than from the chart you can see is off the charts, and the right hand panel is probably more than the 2 standard deviations more expensive than everybody else, right? And while there's some pushback to that view which I presented previously, and people say, oh, India is always expensive because they are good, their companies are good, and they're benefiting from China's outsourcing, or people pulling out from China. But yes, so to say, oh, India it should be expensive, but if you look at its own history relative to its own history, India is still again off the charts expensive lah. So I think again, Asia looks nice, especially China, Korea, Taiwan. But I think you probably want to avoid India in this case. I mean, if you buy something at 2 standard deviations away from its mean valuation, that the risk reward doesn't bode too well, I would say, at the very least. Now, China is interesting because it's got additional factor. I think, again, Chian mentioned that there's this reopening play going on. So we all know that the last 3 years, I think a lot of Chinese have been staying at home and saving lots of money because they can't really go out there to spend, right? So this exactly is the data showing that. So the household deposit hit the record high. So you can imagine all this spending power waiting to be unleashed post the reopening. So I think China probably stands a pretty good chance, right? And also I'd like to mention that China actually started the decline earlier, right? If you recall, you probably can see from this chart, but actually it started the decline, or the peak in Chinese market was in the 2020. Well, it's more like 2020. Well, more than 2020 actually, or 2021. Okay, 2021, and it's coming down. It's been coming down 1 year before the U.S. markets started declining, which was last year. And then, as you can see, right now, it's actually kind of broken its downtrend. It is breaking up, consolidating. It looks like it's going to go up again, or most likely to go up again with all this reopening news and all these business-friendly policies that the government is trying to push right now. Okay, so maybe in conclusion before the Q&A, let me say this, right? So a couple of takeaways from what I just said. First, I think as an equity investor, I think we should consider the high probability, I think, scenario in case a recession does develop in the US, and it looks like if it does develop, then it might be quite it might be quite on the more serious end. And if that happens, we think that at least for equities point of view, the Asia and emerging markets in general might hold up quite a bit better than the US. And China deserves a special mention. So okay, I'll leave it at that, and I'll pass the time back to Roger for the Q&A, and happy to take questions after that. Roger.
Hey, thanks, Paul. Thanks, Chian, as well. I think let's quickly kick off. I think there's this particular question that the audience have asked. I think it's also quite interesting. I think both of you have, I think Chen touched on in terms of the proprietary model, in terms of the chart showing that how strong and resilient the US economy is, and then where are we seeing for the rest of Asia, and especially in China as well. But however, I think Paul, you brought up the point about how attractive, or okay, probably not attractive, but rather China stands out, and especially mentioned to them and all that. As a house, I think we are also quite favorable on that. So how do we reconcile, I think, versus the prop model that Chen have showed versus where our views are in terms of how China is going to pan out, given this recovery story? Yeah.
Sure. Okay, maybe let me chime in on the US part before passing the time to Paul. For the US, I would say that pretty much most forecasters look at the U curve as what Paul shared. They look at the probability models that they have. I would say these are fairly traditional models that may hold up in classic times, but I would say that I would say that for example the U curve is actually predicted falsely a recession a couple of years back. So in short, I would say that the efficacy rate of some of these models have actually decreased. I mean, you can even argue the 3-month, 80-month. There are some other sub-series that the Fed looks at, but in short, I would say that the efficacy rate, I think, has started to come down. We have actually more confidence in our proprietary model because it trains up over decades of history, 40, 50 years, and it's actually fairly granular in terms of how we see the strength is. I would say that at this time, I think I would say that, I mean, even for example, even last year, right? Last year there was a U-curve inversion, and people were already scrambling to say that there was US recession. But our model actually thinks otherwise. That doesn't mean that there's no risk, but I'm just saying that when these indicators turn south, people will start jumping and calling for a recession. We are not so hasty. We consider other things. We have other qualitative considerations as well. But in short, I would say that this is, I think, one key pillar as to why we think a little bit differently from where the consensus is. Yeah. And maybe let me pass the time to Paul on the China call. Yeah.
Yeah, I think again, I'd like to highlight that that the views right now are indeed very mixed, as you can see, right? That there's definitely a very robust debate even amongst ourselves about how to read this the data. So yeah, so I think that there is definitely a lot of data on both sides, which I think objectively, I think we should consider both. But at the same time, I think if you look purely at the equities, I think yes, I still stand by the view that China does look pretty attractive. I mean, whether you have a pessimistic view of the US, and I think China is in a unique position, having declined earlier. So which means that the risk reward is a lot more favorable right now. And then also, there's kind of like a tailwind. So like we've seen last year, again, I gave a very cheeky example of Turkey just now, right? So I mean, even in the midst of very, very bad markets, and last year markets were doing very badly in general, there will be markets that will do well. So I think that's something that we can take note of.
Sure, thanks. Probably this question goes back to the inflation part. I think Chen mentioned about the target is about 3% for US. So what about the Asia and or ASEAN as well? In that same context, what kind of inflation are we looking at? Because we know that inflation is growing as well. Yeah.
Sure. I would say first off, in Asia, I would say that the inflation pressures are less acute. I think essentially, while it is at the higher end, it is certainly not at like 1-2 standard deviations from the past. So I think that's point one. Point two, I would argue that actually, for some of them, they actually benefit. The terms of trade will actually benefit when some of these commodity prices are high. So in short, I would say that for most of these economies, even for example, even Korea, they actually raised rates before many of the central banks. So in fact, their inflation problem is actually has actually come down before the other economies came down. But in short, I would say that Asia doesn't really suffer so-called the inflation problems that we see in the developed markets. I think developed markets, for example, US, UK, I think the key component that has drove up them would be, for example, the rent shelter inflation, the housing home prices. I think in Asia, we broadly see less of these pressures now. I mean, thanks to some of the macroprudential policies that we see being implemented, stalling the home price increase. So I think that's one difference. And also the basket that they look at, I think this shelter rent inflation basket is actually way smaller than what we see in the developed markets.
Okay, thanks, Chen. Probably the next question is to Paul herself. I think Paul, you brought up a point about the China savings surge. The last 3 years, I think they're staying at home and savings up and all that. So if I'm a client right now and I'm an investor right now, right, where are the potential areas and or sectors that probably the spending will go up? I mean, from a layman perspective, probably you're looking at consumer discretionary. Are we looking at that, or probably looking at food items, or any other items that we are looking at, or if I take a more of a macro look from that angle, right? Which are the sectors that probably the clients should be looking at and focusing on, especially when the spending start to comes in? Yeah.
Yeah. Thanks for the question, Roger. I think the Chinese market actually is a very difficult market to navigate. And it is I would like to say what everybody else is saying. Basically, once people have money, they will like to spend in restaurants. They will like to go on a tour, so the airline should do pretty well. And then they'll be spending on other discretionary items, even liquor, right? Hard liquor. They haven't been drinking a lot. They're going out to party. Maybe baijiu sector should be doing. I like to say all these things, but unfortunately, if you look at the actual performance in the market, these, for some strange reasons, are not the ones that have done the best in the market so far. Okay, so I don't want to be too simplistic about these things. Although it makes sense for everybody that logic follows. Again, I refer to my funny slide at the start of my presentation. A lot of things you think that should logically happen, but the data that actually comes out after that, I mean, like the actual performance, these are not the sectors that have outperformed. Yes, they have bounced from the bottom, but they are not the best performers. So strangely enough, some of the best performers have been the stocks that people haven't been looking a lot at. For instance, the private education stocks, EDU or TAL. These are the stocks that have done very, very badly in the last 1 or 2 years because of these heavy government regulations. So anyway, recently they've gone up quite a bit. I mean, there are also other stocks like Bilibili. You can think of it as the China's YouTube, right? People don't think of them as potential beneficiaries, but in the last 2 months, since we hold the stock, it's been up more than 120%. So like I said, the Chinese market right now, I think, is a market for stock pickers. And we have our own AI model to help us make some of these very, I would say, seemingly controversial or contrarian calls. But actually, in this market, that's where we can add the most value, rather than just going by some of these, I would say, common sayings in the markets, which data turns out that these are not the best performing sectors after all.
I see. Okay, cool. Probably this one, the next question I wanted to address it to Chien in terms. I think there's this question from the audience, is that the World Bank and the IMF reports, showing a very growth prospects as well based on region. So the soft landing, I think you have mentioned quite a fair bit in terms of your presentation. Is it largely related to the US, or this is for the all economies that we're covering? Yeah.
Sure. I would say that actually, first off, there is indeed a differentiation in the growth trajectory for the developed markets versus the emerging markets. I think, in short, the emerging markets, especially, for example, China, Asia, they're in somewhat of a different cycle that we see. They don't really, have such huge debt problems. Their policy rates aren't necessarily that restrictive. Their growth engines, some of them are actually fairly self-sufficient. So in short, I would say that the growth rates for Asia is around, say, healthy, at least at about trend growth thereabouts of 4 or 5%, whereas for example, in the developed markets, certainly we see that lower. I think it's about, say, for the developed markets, US, Europe is about fairly just slightly above 0%. Having said that, I would say that why we look at it globally is essentially because I think we have to still expect a certain spillover from the developed markets to the Asia EM markets. So for example, even even if US were indeed to have a recession, I think it's difficult for there to be little or no transmission to the rest of the world. So as such, when we say soft landing, we look at it globally, and for example, if there is indeed the central case would be for there to be a soft landing. If indeed there is a so-called US recession, that would certainly be quite likely would spill over to become a global recession as well. So hence that would be so-called like a global hard landing.
Ken, probably in the interest of time, let's probably have one last final question. I think it goes back to home. So do we have any views on the Singapore market, and especially in the fixed income space? I think on the overall basis, we are quite positive on the fixed income market as well, and the China recovery story. So at Singapore, probably we are kind of the one of the beneficiaries coming from the China recovery story as well. I think this has been covered widely as well, not just from us and from other publications. So any views on the Singapore market itself from equity standpoint and fixed income standpoint as well?
Okay, let me cover the fixed income standpoint first before going a little bit into the equities part. Fixed income, I would say that actually yields are now, say, your T-bills rate is yielding you about 4.2. I think minimally you should be getting at least 4.5 to 5 lah. But having said that, I would say that actually globally, if you look at it globally, you can actually get fairly, the investment universe is wider, and you can get the same, if not higher yields. So I think that probably justifies for a balanced exposure between global bonds versus Singapore bonds. So I think that's the first question. On the second question on the Singapore market, I would actually, I think a little bit differently in the sense that if you are indeed playing on the China reopening, I think there are actually other so-called regions or geographies that could also benefit from China reopening, not necessarily just Singapore. So I will leave it at that. I mean, Singapore would likely be a beneficiary, but I think they wouldn't be the only beneficiary.
Thanks, Chien, and thanks, Paul as well. So unfortunately, we can't answer all the questions in the interest of time. So I think the team have shared a few links in our chat as well. So for the members of the audience today, we actually shared the link into our first Q 2023 quarterly outlook as well. So please feel free to click onto the link, listen to our views, and then watch the video as well. Probably we'll just round it off for today's session. Can we bring up the slides as well? Yeah, so in the CNY mood and all that, right? So we are organizing a kind of like a feng shui webinar next week. So we have the QR code over there. Feel free to scan the QR code and register for it. We have invited one of the feng shui master Jason Liu, to speak about some of your luck and some of the wealth options that we have for going to 2023 as well. So I'll just pause here for just a short moment for everyone to just scan off the QR code and register for the webinar. Yep. If not, then let's round it off for today. So for those who are new to us, or for members of the audience today, feel free to join us and like us on our Facebook and LinkedIn as well. We do provide quite a number of insights and tips on the latest market updates. So some of those views that Chien and Paul have shared, we actually cover them in our LinkedIn post and also cover it in our social media posts as well. If not, thank you, Chien. Thank you, Paul, for your time today, and thank you for everyone who have attended this session today. Happy New Year to everyone, and 恭喜发财. Yeah. Cheers.